It's the time for the Q&A. I'd like to ask Steve Waddington from BNY Mellon Up, Matthew Jennings, who's the Investment Director of Fidelity, and Catherine back up here from Baillie Gifford. Thank you, Catherine. Here's your opportunity. I hope you've been thinking of some questions. I've got some of my own, but I would prefer not to use them. And if I could ask you to wait for the microphone, that would be great. Thank you. First question. This gentleman over here on the left.
Thanks. Colin Cloy. Robert and David, two of our technology experts who've been speaking earlier, have mentioned how important data and the power of data is for the future. For the last 15 years, in my opinion, asset managers have given your data away to the platforms via nominee accounts. Surely, as it appears that no advice is going to be the future, you must change asset managers and really deal more directly with the investing public rather than through IFAs and institutional investors. I know my IFA colleagues might not like that, but 80%, we're going to be stuck with the 20%, and 80% are going to deal direct.
Oh, right. That's a
Marcus has been around with 5 arrows
I know,
20 odd years or whatever, so he was there when data came in direct.
Marcus, I'll start with you, but Matthew would take it. Actually, no, I'll start with Matthew, Investment Director, first, I'll come to him.
Well, I'd be content to take that as a piece of good advice rather than a question, to be honest. I mean, clearly Fidelity has had a relationship with direct clients for many years, and since we've been active in the market. And I think it's definitely something that the organisation has been investing in recent years, which is not to say that we're sort of moving away from dealing with intermediaries either. It is a balancing act, and it's something that's not obvious how to get it exactly right, to be honest. But communication obviously is critically important. Sorry, I can't see, but I'm trying to. Is a critically important kind of tool that we have to meet those challenges, and we're up for the challenge at Fidelity for sure.
Marcus?
I don't really have anything I can say to it, to be honest. I'm just a fund of funds guy. But in terms of dealing directly with the public or going via IFAs, my business is almost extensively 100% IFA. In terms of should we be trying to talk directly, I really don't know. I think that's a question for Michael Dobson.
But I'll throw the question. Do you think multi-manager is a good tool for direct business?
Well, it could be. I mean, the way that multi-manager tries to sell itself is a one-stop shop solution. So we do the asset allocation, we do the fund selection, and you don't have to worry about it. But I still think you need advice as to what's appropriate. Not all multi-managers are trying to do the same thing. Some are taking, in my opinion, extraordinarily high risks. But that's just an opinion, isn't it? So I do think, as good and as helpful as it might be, I still think you probably need advice.
Mm-hmm. And Catherine, a vast number, a good percentage of investment trusts are bought directly by the public, aren't they?
It's something that we've seen change for Scottish Mortgages Registry over time, but particularly post RDR in the last 18 months, the last 12, we've seen the demand rise. We've long had some very loyal IFAs and particularly the private client wealth managers, some of the large houses have been on the register. But what we've seen is a transition of the execution-only platforms really grow demand right through the cycle, almost irrespective of short-term market moves, which is hopefully encouraging that they're getting the message. And one of the challenges that we see going forwards is to make sure that everybody who buys Scottish Mortgage understands what they're buying. And it's in part making sure that all the messages we put out there are accurate, that we're not trying to represent we're being everything to all people. But it's also about the medium, and we are going to look forward. I thought David Rowan's talk was fantastic. It's a lot of the theories that we've been looking at for Scottish Mortgage, but in part it's also how do we engage with that new audience? How do we actually get content out that's meaningful, that reaches the new investors in Scottish Mortgage?
I think it's a good point about how we communicate. We try and ensure that even though our information is just meant to be for professional advisors, that actually that Mr. and Mrs. Miggins can understand it. In the interest of inclusivity,
Yeah, I think for a lot of our business is through institutional clients, but they also have the same comment which comes back, which we need to be able to communicate very clearly with all people. So we may have a lot of technical terminology being used in how we manage the portfolios, but we need to be able to convey that message very clearly. And then if you think through to how that translates to our distribution team, our marketing team, even the comments from one gentleman earlier today to use animation to get those messages across, that helps convey what we're doing, to make sure everyone understands what we're doing. But to the point you just made there, the question then becomes your role. Is it relevant what we're doing for what your clients are looking for? I think that doesn't go away.
I think we're a long way behind many other industries in that, and it can only get better. This gentleman here at the front, apologies if I'm missing someone here.
Hi, good afternoon, Nick Caulfield. Over the last few years, it seems that the return on most asset classes actually has been driven by central banks, policy decisions, et cetera, or the anticipation of that, like tonight or whatever. As sort of fund management houses, traditionally, I suppose, you've looked at company fundamentals and should they be in a portfolio or whatever. But has there been a temptation to actually try and second guess central banks or what they might do to chase returns, or have you just stuck to, well, that's a good company because they've got good balance sheets, et cetera, even though actually, if a policy decision is made, the valuation might go down?
This is the one I'd like to start with you, Marcus.
Yeah. But quantitative easing, I think, has been an amazing thing for financial assets. I mean, the big debate, I think, still going on, and no one has come to a definitive answer, is did it ever hit Main Street? I mean, we know that bond markets are up, we know that equity markets are up, we know the price of property, particularly in London West End, is incredibly high, but is unemployment in Middlesbrough coming down? And that's kind of the thing that we're struggling with. There's a very good fund manager at Magedi called Matt Smith who developed this idea of the fountain of money and how QE worked. And he basically, I think, explained it really well, which was that if you think about America, they created 4.5 trillion of magic money out of thin air. Okay? And they used that to go and buy government bonds. So this is quantitative easing. But in order for them to be able to buy those bonds, they had to induce the current owners of those bonds to sell them. And the only way you can do that is by bidding a higher price. So the first move is the price of those bonds goes up. Now those guys then actually have got assets and liability. They're trying to match them. They've just sold the bond. They've still got the liabilities. They need something that looks like that bond, but there aren't anymore. The government's just gone and bought 4.5 trillion of them. So then they dip down into the next risk tier, which could be corporate bonds, mortgage-backed securities, things like that. But the only way you get the current owners of those to sell them to you is to bid the price up, and so on and so forth. And it means that 4.5 trillion that everyone thought just went into the government bond market didn't. It went into government bonds, corporate bonds, into low beta equities because they look a bit like bonds. And then now, finally, I think actually some of these amazing numbers that we just saw about Google taking out companies for 400 million, maybe it's gone into even things like private equity in a sense, because borrowing rates are really, really low. So there is a temptation, I think, to try and second guess central bank policy. The volatility ahead of every Federal Reserve meeting has been incredible. And for us, it's pretty annoying because, as you were saying, I want to be able to look at fundamentals. I want to be able to see where unemployment trends are going, what the economy should be doing, what the response of companies are to capex, to cost cutting, and try and make a reasoned decision as to how we should be investing. I think they need to get out of the market, but they're not going to do that, are they?
Steve, would you like to add anything to that?
I think one of the points to raise there is that what was the reason and what was the target outcome for quantitative easing? It was to try and stave off depression, if you think back to where we were at that time. And all the points which have just been raised here in terms of what's happened from that has meant that that's in effect reduced the cost of capital for companies around the world, which does then mean that you have had a misallocation of capital, if you like. I think you still can look at the fundamentals to say what is happening in the economy. The central banks and their activity in terms of what happens with monetary policy is clearly paramount in understanding what's happening there, but you can look at a variety of other factors to say, is this really flowing through? We saw aspects around the US data, which Mark had showed on the screen earlier. The question of, even though the wages are increasing, are consumers actually spending that increase in their wages? Now, is that flowing through to the economy properly? So I think you can absolutely still look at the underlying macroeconomic data. It's just that at times there are other factors which are having more of an influence on the market than just the fundamentals.
Catherine, you're scribbling there, I see.
I would say this is something where we are quite different from other fund managers, and this is simply the approach that we take. using that long-term horizon, because when you look at a traditional DCF, a discounted cash flow model for a company, it's very linear in how it values its growth, and it's back to we're simply picking those companies where we see the exponential growth that we believe traditional finance models undervalue over a 5 and 10 year view, on the basis that the market fundamentals will swamp over a 6 or a 12 or even a 2 year time horizon. But over those 5 or 10, if your company can grow that much faster than the market, and you've seen the power of exponential growth explained much better than I did from David Rowan, you really will see that come through. And this is the type of thing where I was saying Amazon grew its sales during the peak of the crisis, not because the US consumer was feeling particularly wealthy, but because Amazon offered it something better than the high street. And those are the companies we're looking for. So we're in the luxury that all we're trying to do, if you like, is pick the best 70 companies from anywhere around the world in any industry. It's a luxury that we have for Scottish Mortgage. So we believe that actually being differentiated. So if QE has gone into the market, it's gone in fairly indiscriminately right across equity markets. And we believe that by being a stock picker in that, you really can choose the winners over the next 5 to 10 years.
Matthew, you're nodding your head there to some extent.
Well, I think, you know, from the perspective of a special situation strategy, you know, there's a clear contrast in the sense that we're more value orientated. But I think to come back to the question, we are definitely finding that bottom up still matters. Company fundamentals are still very important. And if you look at the factors that have been influencing the performance of Alex Wright's put in particular his portfolios recently, you know, it's been really buying into those opportunities where things are changing for the better. And so what is critical in that environment, of course, is to recognise that there is potential for disruption coming from whatever macroeconomic angle it might be, whether it's an interest rate rise or otherwise, but to perform some sort of scenario analysis to understand what your upside and critically, as Alex mentioned, what your downside scenarios are in these different situations, because we don't expect things to stay the same. We expect things to change, but we want to understand what our clients will see happen to the value of their investments under those different conditions.
Gentleman at the front.
It's a shame that David Rowan isn't here to take some questions, but I've got a question about Bitcoin, and you as fund managers, can you see that as an asset class to look at in the future? If it's going to become something that is going to be mainstream in retail and in commercial funding?
I mean, my conspiracy theory is there's no way the Americans would allow it.
Why?
I mean, because they need to have control over their own monetary policy. And if everyone goes away from the dollar, then they can't influence their own economy effectively. Now, the idea of Bitcoin, I think, is genius, absolutely genius. But I just don't see how the Americans and how the powers that be, or how the establishment would ever allow the people to have their own currency, because it means that they lose a significant lever. Now, it doesn't mean that somehow the Americans nationalize the Bitcoin and they own it anyway in some way, but I just can't see how they can allow it.
Will I have an option?
Well, they'll make it illegal to use it.
Mm-hmm. Okay. Anybody else strong views on it?
I agree with those sentiments as well, but also the other factor on top of that is you talked about it as an investment within a portfolio. The question then becomes, how do you value that instrument? And without that fundamental factor there, it couldn't be an investment that we consider.
We're going to have to adapt to if that's going to be the future. We've all got to adapt to this technology that's coming to haunt us. Surely you as asset managers have still got to adopt that same mentality.
The question is, will asset managers have to adapt to that type of technology?
Well, I think the point of the presentation on technology is that actually the asset managers get taken out of the picture altogether, and you go straight to Bitcoin and invest in it for yourself. If you believe in Bitcoin as an investment, there's no reason to come to an asset manager today. You know,
That wasn't my question. Would you as an asset manager invest in Bitcoin as a currency?
I mean, I'm not a currency manager, so I don't have a view on Bitcoin as a currency. But I mean, for the reasons that have already been mentioned, I don't think it's an appropriate asset class to market to retail investors today.
I mean, how do you value something like Bitcoin? I mean, it's going to have rarity value, perhaps, because you, from what I understand, I'm not a genius on this, but I understand you could mine Bitcoins. You can have these sort of servers that actually gradually build up a Bitcoin for you. So it has no yield. It's not like you own a Bitcoin and it pays you £5 every year. So I don't yet know how you value it, but the market value of the Bitcoin has been incredible. It's been going like that. And Hugh Hendry, the hedge fund manager, was saying the only thing you need in life are some equities and a bit of Bitcoin. So there are people out there who are buying Bitcoins.
Yeah, please do.
I think what we would say is actually these are huge challenges that are really challenging the incumbent players. I think the enthusiasm that we would look at is not actually Bitcoin itself, but the blockchain management that sits under it, because it's a bit like saying the internet is a separate tool that you can analyse business. Just because a business owner uses the internet today, it's a bit like saying it uses electricity. I think what you'll find is that the blockchain eventually becomes like that. So if you take either Google, and Tesla has the ability to do this in a few years' time as well, a driverless car that sets up as a company in its own right, that organises on a blockchain, could effectively challenge Uber as a taxi service. You wouldn't need a human input. It could just be done on a mobile app through your thing. That's the sort of technology, and it sounds extremely futuristic. But what's important about this J-curve, the exponential growth, is that might be 5 or 10 years away. So should you pay $45 billion for Uber today? Well, they're doing extremely well. They're a high-growth company, but it's about this technology is picking up so quickly. Where are the opportunities? And it's why we agree with Facebook and the really big guys like Google as well. They are so much cash to invest in this area, and they can afford to get it wrong, because the payoff, the potential market from these things, that sort of more probabilistic way of investing, which we do for Scottish Mortgage, is really about looking at the future and saying just how disruptive can these things be. And it would be the blockchain I would be excited about, and not the Bitcoin itself.
I've got 40 seconds left. Someone had their hand up here. Probably one question to one manager. Sorry about that, sir. This gentleman here at the front.
It's a little bit of a tricky one, because you said how to value Bitcoin, right? Yeah. How do you value gold then?
How do I value gold? Well, it's exactly the same issue, isn't it, really? Now, the thing I know about gold is that every ounce of gold that ever was created still exists today, okay? And every ounce of gold that was created at Big Bang. It's quite cool, isn't it? So it's not like a diamond where you have a pipe, a volcano pipe, and pressures and everything create diamonds. You can make infinite amount of diamonds, but the amount of gold that exists in the universe today was created at Big Bang. Fantastic. Now, how does that help us value it? It doesn't at all. But I look at gold as an alternative to the US dollar, effectively. So when the US is taking on a monetary policy that prints more dollars, I think the value of an alternative currency, like a Bitcoin or a gold, can go up. Effectively, Americans are the biggest investors in the world currently, and when they were doing their QE program, printing more money out of thin air, there was no way they were going to invest in euros, because the euros had euro problems, Greece and so forth. They didn't want Japanese because they just had an earthquake and a nuclear incident. So they went out and they bought gold. Now that QE has finished, and now that the US may be raising interest rates, then maybe you don't need to own gold anymore. And that's why it's gone from 1900 down to 1100 in my mind. I don't know that that's necessarily the case, but that's the best way I can think of using it from a portfolio perspective.
Thank you. I have to finish it. It's not quite true about the gold. I've lost my wedding ring. It's somewhere. But thank you very much for the questions. We've got about 12 minutes or so for tea. So if you could be back about 25 to, I think, that would be wonderful. Thank you very much. Thank you for the fund managers as well.